Since their launch in the 90s, exchange-traded funds, ETFs, and the E-mini S&P 500 futures contract have become very popular tools for investment. However, when you compare the two, it should come as no surprise why futures far outtrade ETFs. Let's look at some of the advantages of trading futures. Management fees. There are no annual management fees with futures, whereas ETFs do have annual management fees. Futures margin is capital efficient, with performance bond margins usually less than 5% of notional amount. Reg T margins with stocks and ETFs are 50% of the value of the stock, or ETF. This is far larger than futures. While some firms offer after-hours trading, ETFs cannot be traded 24 hours a day. Futures allow trading nearly 24 hours, 6 days a week. Liquidity. Many futures contracts, such as the E-mini S&P 500, Treasuries, crude, and metals, all far outtrade in dollar terms their ETF counterparts. In fact, if you look at the average daily dollar volume comparisons between futures and their corresponding ETF, you will notice that futures trade multiple dollar amounts of their ETF counterpart. Treasuries, crude oil, and gold futures trade 20 to 600 times greater dollar value than ETFs each day. The E-mini S&P 500 alone outtrades all ETFs around the world by a factor of 2.56 times. Due to IRS rules, a profitable short-term trade with futures will pay less in taxes than an ETF. All short-term profits with ETFs pay ordinary income rates. While it is true both futures and ETFs are regarded as two of the most successful instruments ever introduced, futures hold the lead in many categories in a head-to-head comparison.